Good morning, traders. It's 8:01 a.m. Chicago time on Friday, the 6th of May, 2016. It's non-farm payroll Friday, as you probably have noticed already. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Overall, the key news, of course, today, non-farm payrolls and unemployment. The number came out at 160,000 versus 200,000 expected, so it missed by 40,000. Private payrolls came in at 171,000 versus 195,000. Manufacturing payrolls change is plus 4,000 versus negative 5,000 expected. The unemployment rate rose by 0.1% to 5% from 4.9. Underemployment rate 9.7 versus 9.8. Average hourly earnings were in line at 0.3% month on month, year on year. Average hourly earnings were a little bit higher, 2.5 versus 2.4. The resulting action on the market is a quick drop and then a pop and then a drop in a three-wave pattern, which we often see on these releases. The only other news there was is that Brazil got downgraded by Fitch, and that Saudi Arabia is putting its market stock exchange um, to an initial public offering. So, not much else to report. Goldman Sachs is laying off quite a few traders. It saw a 37% drop in trading revenue versus a year ago. So it's letting go of a lot of traders from its trading desk. And Deutsche Bank is being investigated for manipulating a market in Italy, in the Italian bonds. Anyway, let's have a look at what we've got. The technicals here. Overall, we're looking at yesterday's action first. The expectations. This was the primary hypothesis yesterday. The day before, we had basically a sideways market after the initial drop. We've had this kind of a stable sideways trade. And so yesterday the expectation is for a pullback into the range, into the value, and then chopping around and then potentially pushing higher later on if we can get through the 54. We did get through the 54 on a false move, on a false breakout to 55, but overall the primary hypo did not work out. The second hypo did. We pushed into through the 54 to 55 right here, and then we dropped. And of course, this happened immediately on the open. Looked more like this, and then we ended up in this choppy trade down near the 2040-50. That was what was expected pre-market, and this is what it looked like in real life. There it is, an immediate jump up. Hopefully you can see this clearly. An immediate jump up to 2055, a drop, and then like I drew a chop market into that 2040 50 level, and just sideways trading with a clear demarcation here, clear LVN right at the 46.75 or 46 even, with the overnight high attempted to take that LVN out and failed and started to move down. And of course, once the non-farm payrolls came out, they dropped them right into the 2023 right here actually. So let's look at that for a second. Let's look at the so what we learned from yesterday. Some really good setups here in the 46 area. And then a very fat distribution up top, a secondary distribution down below, and a market finished on the lower distribution, a normal variation day. and a retest of that 20, 40, 50 point of control. I'll show you where that 20, 40, 50 comes from and why it's painted here in this color and why it's called key. I'll show you that in a second. But first of all, let's look at the overnight session. Here's the overnight. So this is yesterday right here. So you can see the double distribution from yesterday, and the overnight just continued to push lower, and then moved up to the LVN right here, and then just sat sideways before moving lower. It's kind of interesting. It just took a dip lower right before the numbers, if somebody knew what it was, and then we have the drop on the number, and it hasn't recovered much at all off the number. The scene of the crime, or the SOC for the non-farm payroll release. The SOC for the non-farm payroll release is 38.75, 40.3875. If you're using flex levels, it's marked for you. It just put in the low at 20, 30, 50 and is finally recovering. I was looking for a low. Usually happens fairly quickly after the release, a low and a high, and then we generally trade the range, and it just continued to push lower. So it's just overall today we have this range that we have to contend with here between 20, 30, 50 and 20, 40, 50. That's where we're playing, and in general on the open, after the non-farm payrolls, we get an immediate reaction on the equity market as it opens, and then the trade gets fairly dull right after the European close into the close of the session into the weekend, and then the Monday after, we end up getting what is a resting day, or kind of a quiet day. So don't expect too much out of today. That's the point there. Don't push your trades too much. We'll see what happens. I'd love to see. We have this big liquidity level, which if you watch today, if you watch the non-farm payroll release today, if we look at the liquidity that was present there, here's the non-farm payrolls release right here, and we marked this level on our flex levels here at 20, 30, 50 right here. This was a huge liquidity level last month. We played this level over and over and over, and it just traded an enormous amount. And if it didn't trade, what it did was it just held the liquidity a lot, and then it would act as traditional support resistance over an underline, and you could see here as the release came in, you could see this liquidity coming here. The white lines basically are showing heavier bids or heavier offers depending on where the market is at the moment. These heavy lines are met with these big circles. They trade through, but then as soon as we pop back up, you can see that it's a reload. They're reloading. There are buyers that are playing in here, and as the market punches through these levels here, so we zoom in, as the markets punch through these big red circles are hits, or sellers. These are average price sellers. That's why the dots in the middle, it seems to be in the middle of nowhere. It's a sort of a VWAP of all the orders that occurred in that spot. But you can see that the sellers pop in here and it immediately pushes back up, and sellers come back in, and it's just a big battle area. It looks to me like one or more many participants are actually taking the bid and are buying this as it pushes lower. That's what the order flow is showing. And then as soon as it starts to turn around, you see yellow dots pop in here all over the place, and the orange dots just back off, and bids kind of follow in. You see these bids kind of follow in and push through. We're not seeing these bids move up. Generally, we want to see these bids kind of come up with the market if they're really aggressive. But overall, the market's lifting pretty good. You see this large offer again in this 35 area. Again, the key 35 liquidity price. You see this large offer here. The market battles it and pushes through finally, and here we are again. And we're likely to see those reload and reload and reload. Again, the software is S5 Bookmap, and it's an order flow charting software. But it's a great tool to see what has happened and to also see liquidity in real time. Now, let's take a quick look at the big picture and figure out to just understand why this area has been choppy here all week. This is a profile. The red, the bleeding red here is a profile, is a volume profile that was taken from the big sell-off day in the summer, and we've carried everything forward from that point. You can see that the market's really in a huge balance zone. We've pushed the all-time highs, up here from where they were before at 2100. We've pushed the all-time highs and we are pulling back. And where we are now, so as we zoom in here, where we are now is again back in this high volume, extremely high volume area. What is the price for this high volume area? You've got it. It's 2040.50. 2040.50. That's why it's considered a key level. This is a key point of control. And then this the control appears to be remaining with the buyers all the way down to where the next key level below is 2015.75. 2015.75. If you recall, on the way up, it divided the lower distribution from the upper distribution of what the market considered to be value. And we are in this, we entered this zone as we dropped through the 2075 area, 2075-ish, right up here. As we drop into this box here, we have extremely high volume and a very, very thick market, and that's why we have all this chop. Let me turn down my news feed. And that's why we have this really jagged kind of edgy market. There's a lot going on here. And you can see clearly the volume, the blunt volume, the heavy blunt volume in this area. And that's where we are, and it makes for a jittery market, a lot of reversion to the mean, breakout reversion type trading. This is the big picture because we are in this heavy area. So as we push this volume forward, you can see that it's crossing right where we are, right in here. And it's going to continue to do so. I would love to see us test 2015.75. To see if buyers still exist. If we don't, we're likely to slip through and get down into the 1998 area, 1998 area fairly quickly. If we do find buyers as we push through here, we're moving out of the, with the non-farm payrolls today, we're moving out of the highest of the high volume area and are starting to walk down this mountain. If you tilt this on its side, you'll start walking down this mountain to the trough here at 1575. So the auction is moved to high volume for balance, acceptance, then tests either above or below to low volume, to a low volume node, LVN, see if there's any interest, rotate back, or break through and rotate to the next high volume node. That is the natural habit of the market. I won't get into auction theory too much. It's covered in my webinar series on my website if you want to do a crash course on it. But that's how things are shaping up. Now, what do we have today? I'm running out of time. We are in this high liquidity area. The expectation today is that we have an open auction out of range, but the auction is expected to be fairly aggressive on the open. So we're looking for an open rejection reverse type opening. We're looking for an open test drive type opening, and the expectation is open, drop, and then we're looking for a test and a drive back towards 2040.50 for the natural reversion auction. And I'm expecting it to test. If it does work that way, I expect it to get into yesterday's range and test all the way up to that 2046 from yesterday. That would be hypo 1. Hypo 2 is an open auction then test higher, and then look, find the sellers up here to rotate down and start moving towards that 2026, which ends our monthly time framing. Another key area, 2026, is the monthly low, and that ends our one time framing up on a monthly basis. We did the same when we broke the weekly one time framing up at 2065.50, and you see where we are now that we've broken through. Once we break through the monthly, if we break through the monthly at 2026, I would not be long in front of that level. If it breaks through, you're likely to see a quick flush and then a pullback with a continuation down to 2015.75. That would be hypo 2. That's the much more aggressive play. I expect the market to behave today because we are in this high volume balance area. The expectation is it's likely to test lower and push higher, and that was what hypo 1 was. Now I want to remind you again, last just parting words. I know a lot of you drop off at this point. I want to remind you again, it is Friday. It is non-farm payroll day. There's going to be an urge to just trade emotionally, to trade breakouts, to be right, to tell everybody how you're right and all that stuff. Don't do that. Be a professional, be a trader instead of a gambler, and just stick to your plan. Hold on, wait for the market to kind of set up. Look for areas where you might have an advantage, a good risk reward, some distance to your target versus some distance to your stop, some very basic fundamental uh, trading principles, and just stick to your guns and be disciplined today. It's no fun taking a big loss into the weekend, as I always say on Fridays. Good luck, and I'll catch you on Monday. Take care.